Rob, from prey to predator, Shire, which was an acquisition target last year, has this year become the buyer. Does it need to do a deal to bulk up?
Well, that's an interesting question, right? Because the valuation for a long time was supported by the fact that it was going to be picked up by somebody, and it is in that sort of mid-size. It's not quite a big pharma, but it's no longer a specialty company. There are economies of scale in pharma, especially in things like the sales force and the even research organizations. There's moderate economies of scale. The question here is, does the kind of company that Shire wants to be have to get bigger? It wants to be a rare disease specialist, and that tends to be a sort of lower operating cost business in the first place. So I think the answer in the case of Shire is no, it didn't have to do a deal. Whether this was a good deal and whether they should have done this deal is another question.
And the answer to that question, is this a good deal? It looks like a fairly hefty price they paid.
Yeah, they paid a 50% premium for these shares on a $5.2 billion price, which is pretty high, especially considering the cost savings they're projecting, however you capitalize them, aren't going to pay back that premium. So the question is, how do you capture that value again? Now, one way to make that argument traditionally is to say, here's Shire, a company with a larger sales force. You get the little company's products into the hands of the larger sales force, and you can generate additional sales that you wouldn't have gotten otherwise. But again, this is a highly specialized set of drugs they're buying, not sales force intensive. Well, how else do you justify the price then? The natural second option is to say, we see something in these drugs that the market doesn't say. It's almost, doesn't see. It's almost like the board of Shire is like picking stocks, in a sense.
And what might be in this pipeline that the wider market doesn't see? What sort of drugs are they?
Well, the first drug, which is for a rare gastrointestinal disorder, is on the market and it's selling reasonably well. And analysts seem quite confident it can grow. The next drug in the pipeline actually has its approval meeting with the US authorities on the 24th of January, a week and a half from here. So Shire is taking a pretty significant risk that that meeting will go well. The data for the drug works good, but they clearly are looking for a better price by buying ahead of that meeting rather than after it. So the next big data point we're looking for is, do we get a yes? If we get a yes, the drug still has to perform very well to recoup the size of Shire's investment. So it sort of tells you something about the environment in the pharma industry right now, that if you want to grow your company's profits, you have to take pretty significant risk.
Well, the big trends of last year may be over, but pharma still seems to be a great place for M&A bankers to operate. Rob, thanks very much.